You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again. It is time for the Advisor's Option, the program here on the network where we break down everything going on in the world of options for you, the busy financial advisor or asset manager. We get it. These are crazy times. You need to be on the horn with your clients, maybe doing some hand-holding, doing some risk management. We're here to break down everything going on in the world of options, do some education as well, and also have a little bit of fun, especially this time of year. My name, of course, Mark Longo from the THE, optionsinsider.com, as well as from the network upon which so many of you are mainlining these days. Hope you're having a great spooky season out there, listeners. Yes, it is spooky time, so we're going to have a lot of fun on the show with that. If you want to have a good time yourselves, of course, if you're listening just to the Advisor's Option, I don't know why you would just listen to that, but hey, to each their own, at the end of the day. But if you do want to listen to more, of course, the Options Insider Radio Network, the place to go. Get the full network. Subscribe to it on your platform of choice, wherever you get podcasts. We don't judge. It's available on every platform under the sun. If you like what you hear, throw some stars, a rating, a comment. It does help the literal tsunami these days of people who are learning about options almost every day, discover and beat a path to the content, which is always great. And then, of course, if you want more content in your lives, and certainly for you asset managers out there, we are seeing more of you come to the pro side as well, because we get it. You guys have questions. It's understandable. The regular exams you take don't really prepare you for this stuff. Our pro Q&A sessions are a great source of additional information for even the busiest financial advisor and asset manager. And of course, everyone loves a good bit of unusual activity. That's what Options Oddity is for. Also gives you a front row live seat to all the shows we do here, access to our pro podcast feed with 200, I want to say 250 episodes coming at you now the second you hit that button. So you will be awash in some of the best pro Q&A sessions with some of the best minds in the world of options and derivatives. The second you hit that button, chances are your question has already been asked and answered. And if not, hey, there's many more coming that we can answer it there for you. TheOptionsInsider.com/pro is the place to go as we go around the horn and see who is joining us for this very special Halloween spooktacular edition of the Advisor's Option. I am pleased to welcome on once again the maven of all things spooky, New Hampshire, the land of Halloween. I think that's what they call it on the license plate there, where we are joined once again by Mr. Matt AMBERSON, the founder over there at Orats. He also has created a rogue AI, so that gives him some Halloween bona fides as well. Mr. Matt, welcome back to the show, sir.
Yeah, live free or die. That's a pretty good Halloween spirit there.
That's not bad.
But we're here to calm your nerves and allow you to tread in these turbulent waters. So, let's get to it, Mark. Great market out there. There's a lot going on, so it'll be a lot of fun today.
It will be a lot of fun indeed as we kick things off with the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, welcome to the P&L statement, the portion of the show where we break down all the action in the markets since our last episode. Our last episode only a few weeks back. It has been a tumultuous couple of weeks out there. Last week, beginning of this week, seemed like maybe we were heading into a dire period for the markets. There was a lot of red on the screen. We were vacillating at and threatening and even got below the 41.5. We were threatening that 4,100 level and bouncing around it. So a lot going on out there in the S&P. As we're coming into this show, of course, we are recording this on Halloween itself, so a spooky day to be talking about markets out there. The market's not feeling very spooky at all. They're feeling very Christmassy, a little bit of a Yuletide cheer, it looks like, in the markets today, because S&P up about 0.2%, NASDAQ up 0.5%, and the Dow up about 0.4%. That's on the heels of a big rally yesterday, so not only are we no longer threatening the 4,100 level, at least as of this recording. Of course, a lot of you come to this down the road, and who knows what's going on to the markets when you're tuning into this show for the first time. But we are actually threatening 4,200 in the other direction. So intriguing stuff out there. Of course, all of our vol friends coming in quite a bit. VIX was north of 20 a week ago. Now it's at about an 18 as we're kicking off the show. My good friend UVIX taking a nice turn to the dark side, which is exactly what I need out there. If you're confused by UVIX and all that stuff, listeners, by all means, check out our Volatility Views program. We've been talking about that product and just the madness that has ensued as a result of its 10-for-1 reverse split recently. It's something to behold out there. Speaking of things to behold, Matt, you have been beholding this mad market, which coming into this week seemed like it was going to be a pretty dark one. Of course, we still have Powell on the horizon, so he's been known to dethrone and defang a rally really quickly in the past. So all this could be for naught. We could be spiraling towards 4,000 and vols shooting back up to 25 very quickly. But that said, Mr. Matt, what's catching your eye out there in a pretty blood red last week and now looking like a Yuletide green this week?
Yeah, it's like I said, it's been a strange market. Obviously, I've been calling for 3,000 before 5,000. So, if they let it go, I think it has a long way to go. I think they're doing everything they can, they meaning the banks and Powell, to keep this market going for as long as possible. But, I just think there's so much out there that is negative to the market. You really got to be prepared. There's so much spending, and that leads to inflation. They may, they're probably not going to raise interest rates, but that doesn't mean inflation's going anywhere. So that's my kind of overall take. We'll get a nice bounce here. It looks pretty good technically. Of course, as you know from ORATs, we look at I try not to get let my feelings take over, but look at the vol. When the vol starts falling like it is, it's gone up for quite a bit of time, but now it's kind of peaked, come down. That's usually pretty good for the market. We also look at contango, which is the front month versus the back month. That was in heavy backwardation, which is the opposite of contango. It's when the volatility was higher in the front month. That is not good for the market, but that's come back down. And we have some other things that we look at. So it looks like the market might have a little ways to go on kind of a relief rally. But as you say, we have Powell coming. I think he'll try to calm the markets and try to be as dovish as possible. So, but he's going to have some data in front of him. Jobs, they're still paying a lot of money. My two teenagers kind of have the pick of the litter out there. They could make more than I would have dreamed making back in their at their age. We had to scramble for any little job that we got, but so I think jobs are going to be an issue. Tight job market. And it's been interesting trading. I mean, if you take out the top few performing stocks, it's really bearish. I mean, IWM, it's tough being a small business, as you and I know. IWM has come down quite a bit, and as have other indices that are not as that don't have the high market cap. So it's been pretty rough out there. I think the earnings have looked okay. I think there's some weakness underneath. I don't know how the banks got away with it, but I think they haven't really marked to market a lot of the things that's going on with them. But at some point, it's going to come home to roost. So, I think the market's been fairly resilient, given all the numbers out there. It's kind of what I've been talking about. Instead of long puts to protect your portfolio, I've been talking about long puts calendars for a long time. The calendar, you kind of want it to drift down instead of going down fast, where a long put might really explode. Long out of the money put, I used to talk about the garbage options, but now if you have these calendars out of the money, you want the market just to do what it's doing, and they've been pretty nice. And unfortunately, I've been kind of closing some of these out, so I need a little rally to restock and get more on. I've been taking them off at a pretty nice profit. So yeah, that's what's going on in the overall market, Mark.
A lot to unpack there. You joked about your 3,000 before 5,000, but when we were threatening to break 4,100, we were almost getting down to that midpoint there. You must have been rooting a little bit there. You're like, oh, here we go, halfway. And once we're in the middle, once we break 4,000, Matt, who knows? It's all in the wash at that point. It's all up for grabs. So we were getting there, bouncing off that a little bit now. But intriguing stuff nonetheless as we keep on rolling. You touched on earnings. Let's get into some of that fun now, because a lot of that is what's driving these wild markets. Yes, it's time for the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the earnings volatility report.
All right, listeners, let's get to it. The old earnings volatility report. As we've said many times on the show in the past, we are out there crunching all the numbers for you folks, so you don't have to. I will put it out there. I don't think there is a better free source for earnings information and earnings volatility analysis. I certainly don't know of one. I mean, if you want to go commission a report at some large brokerage house and commission custom research, maybe. But even then, I would argue maybe they wouldn't do as thorough of a job. But that said, you guys are getting great data. You know where to go to get your hands on it for yourselves. TheOptionsInsider.com. Click on the Options News and Articles tab to begin your journey for all of these earnings move, earnings season, earnings trades, all that fun stuff we do. Of course, if you want to go straight to the mothership over there at orats.com, ORATS.com, you can certainly get access to the data there as well. And Matt, we are coming off the heels of a weird season, a weird cycle. We ended up coming in right smack dab at par, at even, at 100%. I don't think I've seen that before in all the years now we've been crunching the numbers. So that was a little bit of an interesting new wrinkle for me. In the past, certainly in the early days of the pandemic, one of the reasons we really kind of doubled down on the earnings vol was it was just stunning how little earnings mattered from a vol perspective. No matter what a company said, they could renounce all of their guidance for the next 5 years and the vol would just crater. It was fascinating to watch. So in the early days of the pandemic, earnings volatility was very anemic. We were seeing numbers. Remember, 100% is everything moving exactly in line with its straddle, listeners. And we were seeing numbers in the low 80s and sometimes below that. It was just a just an annihilation of volatility across the board. Then as things got a little bit better out there, we started to see those numbers firm up. And we've been slowly, seemingly inexorably moving towards that par level. And we hit it last month, 100%. So, Matt, I guess what I'm saying is our analysis was perfect. It was flawless. And everything moved exactly as much as we predicted, sir. So I tip my cap to you.
Well, that's the market. I think we have a very good way of looking at it. So, some people just look at what the straddle's trading and did the overall market move after earnings announcement move more than that. You have to do more than that to the straddle. You have to say, well, what's going to be left in the straddle after the announcement? How many days are left? And then you have to do some type of a assumption of a distribution. So we have a pretty good idea of an earnings distribution. So we have an idea of what's left over. So if you get what the straddle is versus what you have left over, that gives you the move. And so we compare that move to the actual move, and we came out at 100% for some historical times. But this season's looking like stocks are moving a lot more. Earnings are mattering more than in the past, which, there's so much macroeconomic information. I thought that might weigh against earnings mattering so much, but it does look like it. The first week, actually, you made some money owning straddle. Second week was pretty good, although not too many, only 200, and we had 7 in the third month so far. So that was that last earnings report was kind of interesting. That earning results. McDonald's, it was the only one that really didn't make some money, but the other 6 did of 10:30 before. So the Monday, the companies that announced Monday. So we're into Tuesday right now. So that's this week. So it looks like this week's going to be pretty rocking. We were asked to do some analysis of earnings, and so we looked at a lot of our indicators, and so we have some pretty good ideas, and we back tested a lot of these indicators. So and our tests come out really well. So we have some good ways to identify what we think is going to move a lot and what's not going to move a lot. It's hard to judge overall, but if you kind of think about it as a pairs trade, because it might be an earnings season where everything moves a lot, but what you want is the gap between what you predicted to move a lot and what you predicted to move a little. You want that gap pretty well there, and then you have kind of an even number of selling vol strategies like iron condors, and then buying vol strategies like reverse iron condors or straddles. And you balance those off of each other, and hopefully when earnings season's over, you were right on the pair. You don't have to be right whether everything went up or everything went down. So hopefully that made sense. But so that's what we're looking like. So we've got some pretty good pick. We had Amgen last night that moved pretty well today. We had Pfizer. It's kind of broke even. And then we have a bunch coming up today, pluses and minuses that we're keeping an eye on. So, earnings season's, this is a fun time of the year. It happens 4 times. This is probably one of the bigger weeks. So this is a good time, Mark.
Yeah, it's been fascinating to watch as we're gearing up and indeed diving into another just crazy season out here. I've noticed an interesting trend. I'm curious if you picked up on this as well, Mr. Matt. Just looking at the numbers, this is a report we ran for yesterday here, looking at some of the upcoming names popping off this week and next week. A Caterpillar popping off today. They were pricing in $11, almost $12, $11.81 in terms of their earnings straddle. In the past, they've moved about $9, so clearly heavy on the vol, heavy on the juice there. A Match Group, a.k.a. the mecca of all online love, apparently, popping off after the bell. So they don't care about Halloween. They're going for it today. They priced in, I should say they moved in the past $1.87. This cycle they're pricing in $2.82, so nearly a full dollar more juice there. CVS in the past they've moved $2.93. This cycle $3.80. I mean, Airbnb in the past they moved about $8.50. This cycle 9.75. It goes on and on, listeners. EA Sports, $5 in the past. This cycle, nearly $6 worth of juice. DoorDash, my goodness, $4.42 in the past. This cycle, they're pricing in $6.56. I could go on and on here, Mr. Matt. Roku, 6.25 is what they've moved in the past. This cycle, $7.10. It varies, obviously, by degree. Some of them not as extreme. Like here's Crocs. In the past, they've moved $8.50. This cycle, they're pricing in $8.84. Some of them very extreme, but it seems like, Mr. Matt, that here's Duke Energy, another one I noticed the other day. A ticker symbol DUK, listeners. They're popping off on the second before the bell. In the past, they've moved less than $1.50. They moved about $1.47 in the past, and coming into this cycle, nearly $3, $2.99. So pretty much a 2x. They're pricing in a two-banger on this earnings. And we can go on and on, Mr. Matt, but it does seem like the trend this cycle is to price in a heck of a lot more juice. So I'm curious if A, you've noticed that out there as well, and B, what do you think that portends for the season to come, sir?
Well, usually when there's that much juice, it doesn't do well for option holders. But don't let that be your method for choosing which stocks to short and what stocks to go long. We actually we're actually kind of buyers of Crocs. What other one did you mention? But anyway, so even though we have forecasts of earnings effects that we use to either buy or sell or give buy or sell signals. So so we're on the long side of Crocs, even though it's pretty expensive. Sometimes we even have an indicator that looks at the relationship of the earnings months. So I mean, it gets pretty obtuse, but that's how that's what we've dug in and found as kind of our way to find these out. On the short side, Toyota going into it's before tomorrow. What else is going in before tomorrow? So we could have a look at it. IR. Peru is after tomorrow, but usually you're right. There is a lot more implied movement in there, but and that has a lot to do with the the macro events and the higher relative VIX that we've seen, that usually doesn't portend well for option holders. But so far, it's bucked a trend. I just think there's so much going on in earnings now, and companies forward looking is looking a little negative, and that usually. Again, there's either a huge relief rally or the stock does get hurt. So, we are seeing some decent movement as the earnings report is showing, Mark.
Could there be a mechanical reason there, too, why the past moves are looking a little light? I know we keep a rolling. I think it's roughly 3 years of worth of data you include in that number. So could we have just rolled past a very action-packed cycle so that maybe makes the past move look a little bit lighter than it has been?
Yeah, that happens, but we go back 12 quarters, so that so that's pretty far. But again, I mean, I think you're just seeing it. You're just seeing the average moves, and it just we're supplying a lot higher. I mean, I think people are realizing as we're coming into the end of some fiscal years that they could only juggle and make things smooth so long. I used to be an accountant way back in the day. So I think the truth is coming out, and we're seeing a lot of movement in these stocks, Mark.
You know what we are seeing now, listeners? It's that time of the year, so let's get to it. Our Halloween spooktacular tricks of the trade.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, Mr. Matt. It seemed seasonally appropriate, Mr. Matt, for our Halloween spooktacular to feature some tricks of the trade. I need some spooky music underneath this. What do you think? That'd be fun, huh?
I thought that music was pretty good. I mean, you got it all going. You got tricks of the trade, scariest option strategies. This is great, Mark.
Let me see. We might have some fun, spooky sounds here in our machines. So let's see what we got, Mr. Matt. Maybe you can get the blood pumping a little bit. Not bad. A little scary.
It sounds like a lion.
That was not scary at all.
Sounds like a little witch, young witch.
There we go. It's a cross between, it sounds like a siren and a giant monster. So there we go.
There you go.
There you go. Set the spooky stage for you, listeners, because it is that time of the year. So we want to have a little fun, but also explore perhaps the darker, the spookier, the nether regions of the options market, if you will, with a fun idea, a fun topic. You know, we've talked about a lot of different educational things and initiatives and strategies, and certainly you're welcome to go back into the archives anytime you want and sink your teeth into all of that. But in honor of the season, listeners, we thought it was a great time to explore our top 5 scariest, spookiest, call them what you will, option strategies of all time. You know, you can carve this up by a lot of different ways. I think we're going to start off with just the pure risk, the pure exposure front, and then go from there. So I've compiled my list. And I'm curious if you agree or disagree with my list. Maybe you have your own separate list, Mr. Matt. I have 4 right off the bat that leapt out to me. I have them arranged in my order from bottom to top. I did kind of leave an opening for number 5 there at the bottom, Mr. Matt. So I thought, as a charitable host that I am, sir, if you wanted to contribute what you think is your number 5 scariest option strat, or maybe you think one of my suggestions here belongs there. I'd be curious, sir. What is your vote for the number 5 scariest options strategy of all time?
Well, I went in to this. I was trying to get this client, and I figured out what they were doing. Great. I'm like, what are you guys doing? They go, well, we buy 1 and we sell 5. I'm like, what?
Oh, Jesus.
I go, that's just, that's right. Blowout.
You just jumped right to the top of my list.
Yeah.
I guess we can start at number 1 if you want.
So, I just went on, oh my God. So, and I knew a guy at Lehman Brothers, and when, what they were doing is just basically selling a ton of teenies, puts, really small puts. And then, it works until it doesn't. So those are the scariest puts to me. You have straddles, of course, and strangles, but generally that's, what you're getting into on those, and usually you'll do it, and you'll monitor the size. But, but these, when you start selling the small ones in size, that's the scariest when you're, if it goes there, you're out of business. That's not where you want to be. So those are the scariest to me, Mark.
So we're going to start breaking it down. I'm going to go with my list, and I have rearranged them a little bit. Matt kind of letting some of the cat out of the bag there for the top of my list. But we'll get there, listeners. Number 5 in our top 5 scariest options, strategies, or techniques, or trades, however you want to view it, of all time out there. And again, this is by risk, and also perceived risk out there as well for some folks. And we'll start at the bottom again and work our way up. Number 5 to me, Matt was just talking about the selling of the teeny put. And I don't care how much you get for the put at the end of the day. The teeny put is bad just because you're not getting really anything for the risk that you are incurring. But there is, of course, this perception that selling short puts is just an extremely risky strategy. Of course, then you go to an event like Risk Management Conference and you see so many papers about the glories of selling puts and harvesting the old risk premium. So there's definitely a place for this strategy for a lot of people out there, especially for you as the advisor or asset manager who are looking to get long a particular equity. If you're willing to work a limit buy order in a stock, you should be willing to sell a put. But at the end of the day, there could be some, explosive risks. Let's say the market just explodes down. You have that gap risk with selling a put. So if you're worried about it, you can, of course, go the put spread route instead. So you aren't naked short units. Now, I put the short put at number 5 at the bottom of my list, listeners, because at the end of the day, as scary as it might be, the stock can only go to 0. So you are limited. You have finite risk. It may seem infinite when you're short that put and the stock is just blowing through strike after strike to the downside. You might just be saying, will this pain, will this horror ever end on my short put? But in reality, the risk is finite. And as long as you're comfortable taking the underlying at the level that you sold that put for, then you should be okay with this strategy. We've talked about variations in the past, of course, with, cash secured. Matt has his issues with that term, certainly understandable. But it's an intriguing strategy, a very useful strategy. It doesn't mean any of these, if they're scary, it doesn't mean they're bad. It just means that there is risk associated with them, and you should be aware of that. So for me, Matt, number 5 is the naked short put. And if you want to add a kicker there, then, of course, selling them for teenies or in today's modern market, a penny is kind of the worst thing you could do. You're taking on risk for pretty much nothing at that point. So you want to hopefully get rewarded for the risk that you are incurring. But there you are, Mr. Matt, number 5 for me, the naked short put, solely for the fact that there is risk. You are naked short units, but the end result, unless you're talking crude oil in 2020, you can only go to zero.
Yeah, I do not like that. Looking at the short put, of course, it can only go to zero. Well, actually, right, the crude went below zero, didn't it? But
yes, crude went negative.
Yeah, your 1 by 2. I mean, the front spread 1 by 2 back tests really well, so I do have a little place in my heart for it. But when it's when you think it's too good to be true, and you're going to win every time is when I think you really get into trouble. So it's all about knowing a risk, having some things against it, trying to find edge, because your edge, as an individual investor, isn't deep pockets. And so you got to find something else. You got to find your edge somewhere. So this is why these are scary strategies, Mark.
Yes. So listeners, unless you're talking crude oil in 2020 or some other funky commodity, most stocks can only go to zero. So you're limited in your risk there, which is why it comes in at number 5. Don't sell them for a teeny. You can't really do that anymore anyway. Don't sell them for a nickel or a penny. You try to get some value for these things at the end of the day. But there you go, number 5. Number 4, Mr. Matt, going in the other direction now. We're going to the upside. And we all saw back in 2021 just how much risk can be incurred to the upside if you are indeed net short units, which is, again, why Matt and I have said on the show many times, endeavor whenever possible to not be naked short units unless, of course, you're looking to sell a put and you don't mind buying the stock there. That you kind of stopped yourself out at that level. But other than that, really being naked short units is never a good idea, and certainly not to the upside, which is why number 4, Matt, my scariest option strategy is, of course, just the naked short call. You're going to see the repeat of a lot of words, the same word here, listeners, which is naked. Naked short is pretty much a bad thing to be in any direction, but it's particularly bad, as we saw over the past few years, to the upside. Imagine being just naked short a call in GameStop a few years ago, or any of those meme names that were exploding to high heaven, listeners. It was just a nightmare. Exploding upside, you're trading at levels at 1,000 volatility. Again, these are things we never thought we would see in our lifetimes as professional traders, yet there they were. So if you need any better example of the dangers of being naked short to the upside, then look no farther than all the fun of 2021. If you're going to sell that call, of course, sell the call spread. We talked about it before. Find some way to spread off your risk. Maybe sell the call against your stock. So now, of course, you have covered call. There's many ways to sell calls without putting your entire life savings and more on the table, listeners. So at the end of the day, Mr. Matt, number 4 for me is the naked short call. What do you think about it, sir?
Yeah, I mean, it's bad in a few for a few reasons. One is you don't get that much, especially versus the short put in most cases. And yeah, you don't even have zero as a limit. That could go anywhere. And I could still remember trade. As a market maker, have one bad position in a takeover stock, and you thought that it would never get there, and then it gets there. So anything can happen. And the one thing that you don't want to be short is a call. when there's a short squeeze, or say you're trading orange juice or something. So be careful out there. No short calls, no short units.
Well, what if I told you, Mr. Matt, that number 5 is scary naked short put, number 4 is scary naked short call? Now, what if I told you for number 3, Matt, we're going to combine the two? Oh my God, we're going crazy here. Maybe I should stop the show now. I don't know. Matt, can you handle this?
It's a little scary.
All right. Well, I'll try to keep it manageable for you and for our gentle Constitution listeners. Let's go out. Number 3, listeners, we're going to combine the scariness of number 5, the naked short put, and the horrifying terror of number 4, the naked short call. We're going to put them together in one absolutely, completely terrifying strategy called the naked short strangle, listeners. So what is a strangle? We talked about it on the show before. You're selling now a naked short put out of the money, and you're selling a naked short call, again, out of the money. And so the number 5 and number 4, we just took it and put them together. You decided, you know what? There's not enough risk in either of those by themselves. I want to add it all up. So I want risk in just any direction. That's what I want. Naked short strangle. Why it comes in at number 3 and not higher, listeners, is because, as I mentioned, you're selling the out of the money call and the out of the money put. So you're giving yourself a little bit of cushion, a little bit of wiggle room. If the stock, whatever underlying you're trading, if it hangs out where it is, you have a chance of making some money on this trade and not just getting your face ripped off. Even though in these markets, the probability of getting your face ripped off looking pretty high right now. So number 3, Mr. Matt, for me, of my top 5 scariest option strategies is combining 4 and 5 together into the absolutely horrific naked short strangle, sir. What say you?
Yeah, I mean, strangles, and it seems like it's more popular now. I mean, I got a call the other day. It's an older gentleman. I want to sell some short strangles. I'm like, I don't know about that.
and he found his way to you.
Yeah, oh yeah, we get a lot.
Hasn't he heard your net short units talk before? Hasn't he heard you on any?
Yeah, I know. So I guess as long as you know your risk tolerance, and it's in a very small part, go for it. But it's not something I like to do, Mark.
No, not my favorite thing either. I'm hard pressed to think if I've ever sold a naked short strangle. I don't think I have, because why would I? I'm not an insane person, listeners. And also, like Matt, I was brought up in a market making environment, so I was trained very early not to have any net short units, because that way lies ruin. And so we're trying to avoid ruin here, listeners. Maybe not for this list. Maybe this list we're trying to bring the ruin. But outside of that, usually in our options trading lives, we're trying to avoid the ruin. All right, Mr. Matt, we're going to turn it up. So maybe if you need to step away for a little bit, I understand. If it's getting a little bit too spooky for you, if you can't handle the heat, I understand if you got to get out of the kitchen for a little bit, because we're turning it up almost, not quite to 11. 11 will be number 1. We're going up to, let's say, 9.5 or a 10, though, Mr. Matt, because if you thought that was bad for number 3, listeners, we took all the terror of the naked short call and all the horror of the naked short put, and we combined them together in the naked short strangle. Now, what if I said to you, we're going to take those from out of the money and we're going to compress them all the way down to the at the money strike now. So now, instead of selling a naked out of the money call, you are now selling a naked at the money call. And instead of selling a naked out of the money put, you are now selling a naked at the money put. What have you done, listeners? You have, of course, sold a naked short straddle. That is our number 2 scariest option strategy of all time. Why is this above the naked short strangle? Well, as we said with the naked short strangle, you have a little bit of cushion. You have a little bit of wiggle room. That's why the iron condor is more popular with most people than the iron butterfly. The iron butterfly is just a short at the money straddle, or long if you go the other way, and then the wings to hedge against it. The iron condor, of course, if you're going to go the short way, of course, a short out of the money strangle, then another out of the money strangle, long one against it. So you have some cushion, some wiggle room. Most people who aren't insane are more comfortable going that way. They like a little bit of wiggle room, a little bit of cushion in their trades. The short straddle gives you none of that. The short straddle says, with every tick of the underlying away from that at the money strike, you are going to lose money, and you are going to lose it hard and fast, and it's going to be painful. And so, obviously, you're collecting a lot of premium to do this. So, if perhaps this is your bag, you like to trade just popping Tums all day, sweating profusely, staring at every tick in the stock. And I knew some guys back on the floor who were that way. You could walk in, typically on expiration day, listeners, you would see this most pronounced. And you could just look at any pit, and you could instantly tell, okay, who had closed out their stuff, who was maybe long a little bit of premium looking to scalp, and who was just naked short, because the naked short guys on every strike were just sweating bullets, popping Tums, looked like they were about to collapse at any moment. It could work out for them at the end, but they sweated. They had the pain along the way to get there, and that's exactly what the naked short straddle is. It's pretty much pain all the way up until expiration. And then maybe at the end, if you're lucky, you get to keep some small piece of the premium that you sold. But you certainly paid for it in other ways. Sweat, maybe blood and tears, maybe all of the above. Mr. Matt, what are your thoughts on our number 2 scariest option strategy of all time, the naked short straddle, sir?
Well, you kind of busted me, Mark, because I had to put another butterfly on. So I put it on for $1, and it's the 4190 in SPX. In SPX with 15 minutes left is 4190. So I'm sweating it. I'm sweating out yet another butterfly.
You just wanted to just epitomize what I'm talking about here for our listeners. You wanted to give them a living, working example. Hey, it worked out for you last time. You got a bullseye with that one, so maybe you'll get it again.
Hey, I'm superstitious, so I had to put another one on. So
at least you're doing the fly, though. You're not going just naked short a straddle.
No, this is more like an iron butterfly, but it's a regular butterfly because you have your units are flat. And but I've seen a lot more people on YouTube and stuff doing more butterflies, wider butterflies. So I think that's an interesting way to do it. You don't have to just do a short straddle, which you should just not even have that in your repertoire. There's a lot better ways to do it. Calendars, wide butterflies will do the same thing, give you the same look. Just look at the payout picture, and that's what you're trying to replicate. So don't do it. Even though we say we backtest things with short straddles or long straddles, that's just to prove a point how much especially around earnings things are moving. But that's not necessarily the way that you want to do it, Mark.
Yes, Matt backtests them so you don't have to trade them, listener. That's the whole point of the backtest. That's why he does it. You don't have to put your capital to work. Yes, I used to have a co-host on our VolView show way back in the day, Mr. Matt, talking again about the iron butterfly versus the iron condor, so the short straddle versus the short strangle. He used to always say that the iron condor was an iron butterfly for cowards, and that the real men would do the iron butterfly. I always thought that was a funny perspective out there. But yes, don't do this, listeners. Don't go the naked short. If you're going to go the short straddle, by all means, make it an iron butterfly, so at least you have some protection against the madness that unfolds. All right, Mr. Matt, I don't know. Are you ready for number 1, or should we just stop it? Is this too much for you and for our listening audience? What do you think?
I think we could handle it. We've done a good job so far.
All right, number 1, Mr. Matt. You kind of let the cat out of the bag with this one, but I was like, what in terms of risk can take it away from the naked short straddle? The naked short straddle just loses in every direction. It's a fantastic strategy if you want to just hemorrhage money and or sweat blood and tears. But there is one thing that eclipses it, listeners, and that is our number 1 scariest option strategy of all time. Matt alluded to it earlier. You might have heard him call front spreads. Also, we like to talk about them here on the network as effectively just ratio spreads. That's what they are. You most frequently seen them done, and again, we're talking the net short units variety. So you're going to be long one. Let's say you're talking a vertical call spread, listeners. Long one, and instead of selling one out of the money call against your, let's say, at the money or nearer out of the money call, you're going to sell 2 or more. And that's where the scariness comes in, the or more. Selling 2 already, your net short a unit to the upside. We talked about the danger of that. That comes in somewhere around our number 4 on our list. What really elevates the front spread, the ratio spread to the number 1 position, listeners, is the effectively unlimited leverage to the upside that you could apply to this to really just cause problems for yourself and for your portfolio. Matt was just talking about his client who's doing these front spreads or ratio spreads 1 by 5 So yes, listeners, a traditional spread would be 1 by 1. That means you're net short 4 units on that trade. What's the worst that could possibly happen to that? Imagine being long 1, short 5 in GameStop in 2021. Listen, that's probably about the worst case you could imagine for that scenario. But being net short that many units, I get it. It's attractive. You buy one, you say, wow, this is really expensive, maybe more than I am comfortable paying. How can I offset this premium that I am paying for, let's say in this example, an at-the-money call? Well, you could sell a out-of-the-money call against it, and now you've defrayed some of that, and now you've bought a call spread rather than a call. And now it's very easy to take the next leap and go down that slippery slope and say, well, if I sell 1, I'm offsetting this much. If I sell 2 or 3 or 5, now I'm offsetting a bunch of it. Maybe I'm even collecting a credit to buy this call. Why wouldn't I do that? They're paying me to buy this call. Why wouldn't I do that? Well, the reason, listeners, is, of course, you are net short a whole bunch of units in whatever direction you're doing. This could be put spreads as well. And that way lies ruin. There's a reason why we've said many times on this network, listeners, don't get short units. It can work out. You can skate. Sounds like Matt's client there is skating for now, but it will come back to haunt you at some point. Maybe it'll be right now in spooky season. Maybe it'll be at some quiet period when you least expected it in January when you're off doing something else, and next thing you know, your stock is taken over, or whatever the case may be. And trust me, you do not want to be net short any units, let alone multiple units, and that's what the front spread entails. That is why it is our number 1 Halloween spooktacular, spookiest, scariest options trade or strategy of all time. Mr. Matt, what are your thoughts? Agree, disagree? What do you think?
You know, I said it earlier. This is these ratios. They seem good especially if you're looking at the Greeks right around where your long is, but once it gets out of control, it gets ugly really quickly, and there's a lot of embedded ratios out there where in big trades that aren't necessarily options trade, but there's a lot that you could learn about options trading and take that to the risk out there in the economy in general. So you always want to find that, and you never want to do it. So I passed along that initial client. They went out of business in the Volmageddon in 2018. So don't do it with your own capital or anyone else's capital, Mark.
All right, Matt, we did our top 5 scariest options, strategies, or trades of all time. But maybe for some bonus spooktacular points, let's also throw in our personal, the scariest option strategy name. Which one just sounds the craziest? Which one sounds the spookiest? There's a lot of weird names for option strategies out there. We get asked all the time, what are the origins of this weirdo name? And oftentimes we have to say, there's no real answer to that question. It's just lost in the primordial ooze days of options. Probably better forgotten if someone did know the answer. But that said, I have a couple that come to mind for me, Mr. Matt. But when you're out there thinking of the spookiest, the scariest options strategy name, what comes to mind, sir?
I don't even think this is close, Mark. The Iron Duck. I heard it a while back, and it's like an iron condor. But you sell like you sell the put spread, and the call spread is only about half of the spread of the put spread. So there's no risk to the upside. So it looks like a duck. So there you go.
The iron. This is a new one to me. I have not encountered the Iron Duck before. I agree with you. I think the iron branding, the iron nomenclature is the way you have to go. I was trying to decide between the Iron Condor and the Iron Butterfly. A butterfly is not that scary at the end of the day. I think Iron Butterfly, people think back to, the band from the 70s, or maybe that creepy scene from Silence of the Lambs. So there could be a little bit of spook factor with that. I probably would have to go at the end of the day. The Iron Condor, it just sounds cool. It sounds ominous. People also think of Iron Maidens, and being stuck in that horrible thing full of spikes, or that awesome band from the 80s as well. So I agree. You have to go iron in some capacity. The Iron Duck, though, you may get the award for the surprise scariest option strategy, because that's not one I'm familiar with. The Iron Duck. Break it down for us one more time. What is the Iron Duck?
So, picture it, it looks like a bill. So you have it looks like an iron condor, but the right side of it comes up and it goes right above the break-even line, so you can't lose. So it kind of like looks like the eye of the duck and the beak of the duck. So you got double widespread on the put, so you could lose a lot on the put, but you can't lose if it goes up. It's above the break even, so your head's always above water. So it looks like a duck. It's pretty fun. I'll put a screenshot in the chat here, so you could maybe describe it better than I can.
I think we may have hit on the topic for a future show, sir. All about the Iron Duck, revenge of the Iron Duck. I would be down for that, listeners. I don't know. So, listeners, what are your votes for either your personal lists of your top 5 scariest option strategies of all time, and also your vote for the scariest sounding options strategy of all time? We want to hear from you, folks. Speaking of hearing from you, it's that time to squeeze in a few of you with a little bit of the old Halloween spooktacular office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to a little bit of Halloween spooktacular office hours. We are already bumping up against it. We're having fun here on our spooktacular. We got time to squeeze one of you in. This is the fun one from Francis, Matt. I'm sure you'll have some thoughts on this. I know our listeners have already weighed in as well. This question from Francis is, has Matt been able to backtest the intraday volatility of SPX options over the past 18 months, aka the effective lifespan of 0DTE options, to see if there has been an increase since their launch? I think this could be an interesting topic for the podcast. Thank you. Well, we did have a question of the week just last week, Francis. Maybe that inspired your question. I don't know. But along these very same lines, and we asked our listeners last week, who are at the end of the day the ultimate arbiters of all these things. We said, hey, we've got more data under our belts now about all things 0DTE, so it's time to revisit this question. Quite simply, do 0DTE options increase intraday volatility? I gave you heck yes, heck no, or I still need more data. And Mr. Matt, at the end of the day, our audience came down on the heck yes side, 63%, 29.6% saying heck no, and 7.4% saying I still need more data. I'm curious for you, Mr. Matt, because this poll just ended last week, so it's very fresh. Where do you fall on this poll? Are you on the heck yes, heck no, or I still need more data side? And then speaking of data, what do you have to say for Francis here? He wants to know if you've been crunching the numbers on intraday SPX vol to see if 0DTE has been a catalyst for more vol, sir.
Yeah, I mean, this is a tough one to measure, right? Because I think right now, I mean, there's definitely been a lot more intraday volatility lately, but, the market has just been pretty crazy. So it's hard, it's hard to get a normalized test. Can you really isolate the 0DTE as the cause? I would say absolutely not. Just in general, I think, as a past market maker, if I were a market maker, I would love it, because I think you could really get a lot of your risk off. Like, the worst thing is systematic risk. When the market makers used to just have this huge short put long call position, that was the worst for them. So when it started going against them, they'd have to panic, and it really deadened volatility to the upside. Now what you're seeing is the slope, which is the puts versus the calls. It's really been coming down, and I think that largely is because of 0DTE. So they don't need to bid up the puts to get those in, because the 0DTE, they trade so evenly that I think it's really saving the market. There's, like, with all the things that are in the news right now, God, we would have had it crash. It seems like historically, but I think the 0DTEs actually really have a dampening effect for volatility. Because the market makers really don't have to panic. They could really get there's so much volume and so much two-sided trading that they could get their positions how they want them instead of being dictated how it used to happen in the past. So that's how I feel about that. As far as backtesting, like I said, it's really hard to isolate only 0 DTE. So no, but it's definitely a lot more volatile now. It's a lot more difficult of a trade selling vol in the 0 DTEs. So let's see how my looks like we're not going to do it this time, Mark. 41.93 unless we get a really good close. We're not going to in the last 20 seconds. It's not going to be pinned.
Your lottery ticket has not worked out this time, unfortunately, sir. Well, also unfortunately, that does bring to a close our epic Halloween spooktacular. Did you have fun, sir? Did you feel was it a little too scary for you? We could dial it back for next time if it was too much.
It was great.
All right, listeners.
That was really good. I thought you had some really clever things there, Mark. You're really working overtime, and that crack department there is doing a great job.
At the end of the day, that's why we get the big bucks here for Halloween spooktaculars. Hope you folks, listeners, had a good time out there. Hope you're having a great spooky season. Again, we want to hear from you. Maybe we'll do a quick flash poll for today as well. What are your thoughts on the scariest option strategies from a risk perspective, and of course from just a weird, scary sounding name perspective as well? I'm sure once we put this poll out there, people are going to write in with all sorts of weird, crazy strategies that we never even considered, Mr. Matt. I'm looking forward to what you folks have to say. And speaking of the folks, Mr. Matt, in the meantime, if they want to check out everything you're cooking up over there in the land of ORATs, where should they go? What should they do?
Yeah, come on over to ORATs. We've got some great stuff on our dashboard product. We continue to add things. We have this market intelligence that shows the largest trades today and who traded for the largest profit. So that's kind of fun. We have post-market movers, what's moving right now, 1 minute after the close. What's coming out with earnings? Are they over or undervalued? It's all color-coded, so people are loving that. And we're doing some great stuff with our millions and millions of backtests. We're starting to combine them to come up with optimal portfolio. So that's going to be really fun. We're going to be working on in the coming months. So very exciting. And then we're going to have some more automation, systematic strategies, as I call them. Other people call them bots or whatever. But we're going to have systematic strategies in order to implement some of those optimized portfolios. So there's a ton going over. Come on over to orats.com. And thanks for the show, Mark.
Check them out over there, orats.com. A lot of great stuff. We really just scratched the surface of it here when we talk about the earnings data and some of the back testing. A lot more lurking over there. You can find it for yourselves, orats.com. Glad to see so many of you are responding and hitting up Matt with your questions, your feedback, and taking advantage of all the great stuff and the great tools they have to offer over there. It really is unique stuff. Orats.com, the place to go to learn more. And, of course, check out our friends over there at optionseducation.org on the OIC side if you want more information on how you can incorporate options into your practice. That is going to do it for us here on the network today. I have to get the heck out of Dodge. I got to go spook some kids, set up my Halloween setup. A lot of fun to be had here. Hope you're having some fun. Hope you're staying safe in these markets. And we'll see you back here next month, another episode of The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.